We like to think history is shaped by countless forces, politics, social movements, global events, and it is. But sometimes one person, one decision can tip the scales and set off events that ripple across the world. The story of the Great Depression, the most devastating economic crisis of the 20th century, is one of those moments, and at the center of it was a single man, Charles E. Mitchell, the powerful head of National City Bank. Mitchell wasn't a small-time investor or a distant bureaucrat. He was one of the most influential financiers in America, a man whose decisions affected millions. By the late 1920s, he had enormous control over credit and lending, and he used that influence to fuel the roaring stock market of the 1920s. On paper, he was helping Americans build wealth, but the system he encouraged was fragile, speculative, and unsustainable, and it would eventually collapse with catastrophic consequences. The 1920s were a decade of unprecedented economic growth. Automobiles rolled off assembly lines, radios brought entertainment into living rooms, and skyscrapers reshaped city skylines. Stocks soared. Ordinary Americans weren't just watching, they were investing. They bought shares on margin, borrowing money to chase market gains. Credit was cheap, optimism was high, and speculation ran rampant. People measured success by stock prices rather than the value behind them. Mitchell understood this system, and he exploited it. As president of National City Bank, he encouraged banks to lend money to brokers, who in turn lent it to investors. He promoted massive margin buying, effectively allowing people to borrow up to 90% of a stock's price. This fueled a stock market frenzy. Prices rose not because companies were suddenly more productive, but because people kept buying, believing prices would keep climbing. On the surface, it looked like prosperity, but it was an illusion. By 1929, the market was a house of cards. Stock prices were detached from reality, valuations were absurd, and a single shock could trigger panic. That shock came in late October. Investors began to realize the market's gains were based on borrowed money, not real profits. Confidence wavered and panic spread. But here's the critical point. Mitchell's policies had created the environment for disaster. The speculative bubble wasn't just a natural occurrence, it was engineered, encouraged, and amplified by him. On October 24th, Black Thursday, stocks began to collapse. Millions of dollars vanished in hours. Investors panicked. Newspapers reported chaos on Wall Street. In a desperate effort to stabilize the market, a group of bankers, including Charles Mitchell himself, pooled resources to buy large blocks of blue-chip stocks. This temporarily slowed the fall. Prices steadied for a moment, and the public hailed the effort as heroic. But the relief was fleeting. On Black Monday and Black Tuesday, October 28th and 29th, the market plummeted again. Millions lost everything. Banks failed. Factories closed. People who had invested their life savings were left penniless. The stock market crash didn't cause the Great Depression by itself. It exposed the fragility of a system built on speculation, excessive credit, and unbacked optimism. And at the heart of that fragility was Charles Mitchell's vision of finance, a system that rewarded appearances and short-term gains over sustainable value. Mitchell's influence didn't end with credit expansion. He actively promoted the idea that investing in stocks was a safe and accessible path to wealth. He appeared in public, in newspapers, even in advertisements, portraying the stock market as a tool for the average American to secure prosperity. Millions listened. They borrowed money to invest, confident that the system was stable because someone like Mitchell was in charge. They didn't see that the real wealth, productive businesses, tangible assets, skills, was being sidelined in favor of speculative gains. This wasn't just a personal failing, it reflected a deeper structural problem. The 1920s financial system encouraged risk without accountability. Banks could lend endlessly because they assumed someone else would cover the losses. Investors assumed prices would always rise. And Mitchell, by expanding credit and promoting speculation, amplified the risk exponentially. When the market finally corrected, the consequences were devastating. Millions of Americans felt the impact personally. Families who had invested life savings in stocks saw them disappear overnight. Banks that had lent recklessly failed, wiping out deposits. Factories closed, unemployment soared, and the American dream of prosperity seemed to vanish. It's hard to overstate the human toll, and it all traces back, in part, to Mitchell's policies and his vision of an economy powered by borrowed money. The lesson here is not that Mitchell acted maliciously. He was ambitious, intelligent, and a product of his time. But ambition without restraint can be destructive. By encouraging speculation and detaching wealth from real value, he created a system that couldn't withstand panic. History shows us that financial leaders wield enormous power, and that power can amplify both prosperity and disaster. Consider this: the stock market crash exposed the illusion of wealth. Millions thought they were rich because their portfolios were booming, but that wealth was fragile, built on borrowed money and speculative prices. Just as in France under John Law in the early 18th century, or Japan during the 1980s bubble, what appears as prosperity can evaporate instantly if it isn't grounded in real value. Mitchell's actions masked the fragility for a moment, but the system eventually corrected itself with brutal consequences. The crash also demonstrates the dangers of trusting authority without understanding underlying fundamentals. Investors believed that because Mitchell and other leaders were buying stocks, the market was safe. They measured success by appearances, not by real assets, production, or utility. When the illusion collapsed, the results were catastrophic. There's another point worth noting. Mitchell's influence highlights the moral hazard inherent in financial systems. When leaders are trusted to intervene, they are given enormous leeway. But when their actions encourage risky behavior without accountability, the entire system becomes more vulnerable. In the case of 1929, Mitchell's policies encouraged everyone to overextend themselves, creating a chain reaction that amplified panic when it came. The consequences were enormous. Between 1929 and 1933, unemployment in the U.S. rose from roughly 3% to 25%. Homes and farms were lost, banks failed, global trade contracted. And yet these events also provided lessons. Wealth built on speculation alone is fragile. Real value comes from productive assets, skills, and resources that endure. Mitchell helped trigger the crisis, but the underlying lesson is timeless. Measure wealth by value, not by appearances. History also shows us that recovery depends on real assets and skills. During the Depression, farmers who could grow essential food, craftsmen who could produce needed goods, and businesses that adapted to immediate needs survived. Financial paper alone could not sustain anyone. Mitchell's era proves that policy and influence can magnify both risk and resilience, but only when grounded in tangible value can people weather systemic shocks. Charles Mitchell himself would eventually face consequences, though not immediately for triggering the crash. His aggressive strategies and later missteps tarnished his reputation, demonstrating that influence and ambition, like paper wealth, are fragile without real substance. His story is a cautionary tale. One man, even with the best intentions or the greatest expertise, can trigger outcomes that ripple across decades when the system is fragile. Whitney, Mitchell, and other figures of the 1920s all illustrate a central truth: appearances can deceive. Confidence, Trust and authority can temporarily mask fragility, but they cannot create real value. The Great Depression wasn't caused by one man alone, but Charles Mitchell's policies and influence amplified the bubble and triggered its collapse, exposing the vulnerability of an entire generation to speculation and illusion. Because history shows us that when the bubble bursts, real value is the only thing that can save you. If this gave you insight into how fragile our financial world can be, hit subscribe. History isn't just about the past, it's a roadmap for understanding the present and preparing for the future. And the story of Charles Mitchell is one of its most powerful warnings.